Hey everybody, what I wanted to do this week is talk about mutual funds and pretty much, kind of go over, kind of what a mutual fund is and, what it does, how you can use it and, kind of what the benefits and so on you would be from a mutual fund. So what I'm going to do is, we're going to have that conversation around mutual funds. Actually, I'm doing a little different today, so I'm going to actually take the headphones off because don't need them. I was doing Facebook as well as YouTube live together, and I'm not going to be doing that. I'm just going to concentrate on YouTube this week. Doing this from my phone, kind of doing it the opposite way. So hopefully I get a little bit better background, a little bit better color, and go from there. So as I kind of tweak this a little bit, it'll get better and better. But anyway, putting that aside, first I'm going to start with what a mutual fund is and then how it's beneficial to you. So a mutual fund is basically like a conglomeration of stocks or other investments. So think about it this way. Let's say I have $1,000 and I'm saying, I want to invest in, stocks, but I want to be diversified. Everybody says to be diversified, and that makes a lot of sense. So how do I diversify with $1,000? I mean, there's not a lot you can buy at, one stock here, one stock there. If you try to buy enough shares, it's going to, consume that $1,000 pretty quickly. So one thing that has been created is, look, if I have $1,000, maybe I can buy 100 shares of, Verizon, and you have $1,000, you could buy 100 shares of, Home Depot, and somebody else has $1,000 and they're going to buy 100 shares of Amazon, whatever it might be, right? So let's just say all things being equal, we each buy our $1,000 worth of a particular stock. So I have one stock, you have one stock, and person three has one stock, and obviously multiply that by so many more people. But the idea is then we're not diversified at all. So what do we do to make that case when we don't have tons of money? Each person doesn't have a ton of money. So what mutual funds were designed to do is to take a small amount of money from each person, bring it together, and create a buying power of a lot of different stocks. It could be other investments as well. It could be bonds and stuff like that. But, let's just use that. I'm just going to say stocks, meaning whatever the investments are. So what people did was created this conglomeration or bringing together of a bunch of different investments into one big investment. Kind of like if you ever heard of Stone Soup. There was a book years ago and it was Stone Soup. One guy came and said, hey, I have a stone, I'm going to make soup. One person said, oh, I'd love to contribute to that. I have carrots. Another person said, I have celery. Another person had chicken, so on and so on. And next thing you know, they have a big soup from a couple different items. So that's the idea of a mutual fund, is for everybody to bring their, money together to increase their buying power. That's the idea. So instead of me just having one stock, now I can have an investment in multiple stocks across a portfolio, or multiple investments across a portfolio. With my $1,000, I now have more buying power to diversify myself. So that means that instead of having, my shares of Verizon and shares of, Home Depot and shares of Amazon or whatever, I have an investment, or I have a number of shares of this mutual fund, and the mutual fund then owns all these assets. So it's basically like investing in a fund or investing in a particular asset that has a bunch of other assets in it. So that's basically what a mutual fund is. It's this investment that allows you to diversify. So now with that, what does that entail? So some of them have fees, right? So if someone's creating a mutual fund, they need to get paid as well. So there's actively managed funds, and then there's passive funds. So the actively managed funds would be where there's individuals out there, professional investors, and they'll say, okay, my mutual fund has, I'll use the same examples. Verizon stock has Home Depot stock, has Amazon stock. So that's what I'm offering, and based on what you're getting, this is what the net asset value is. Would you like to invest in that? So you go ahead and you invest in that particular, that particular portfolio, and you have investments in those different assets that it holds. and other people do the same thing, and it creates a great buying power that fund can then, purchase all of those assets. And I'm using three, but, assume 15, 20, 30 different investments that the funds are distributed across. Well, over time, one stock might not be doing as well. I'll use GE as an example. Lately, just this past week, they were dropped from, or maybe last week it was, they were dropped from the Dow Industrial Average. So that stock then, the portfolio managers at some point, maybe even before they were dropped, said, I don't think this isn't a good investment, in my opinion, if I'm that manager of that fund. I'm not sure that I think this is a great investment anymore. So I'm going to go ahead and take that sell off that investment out of this mutual fund, and we're going to take that money and then buy something else. And so there's a person that makes those decisions, and obviously you have to trust that they're going to make good decisions, but you'll invest knowing that these professionals are managing that fund. So they're determining what the fund invests in, whether it be, the three stocks I mentioned, then maybe they'll get rid of one, or one is more heavily weighted and they want to invest more. And again, I'm just using three as an example, but most of them are going to have 10, 15, 20, maybe more investments. Some are going to have significant holdings in certain companies and, certain assets, and, maybe small portions of other ones to kind of diversify it, even further. So with that said, they're going to be potentially adjusting in and out of certain positions, and, that someone has to be able to make those calls and make those decisions, and the reason why. And then as the investor, you can decide, well, I don't really like the way this person's going with these investments, so I'm going to get out of it. So you have that option as well, just like as if you traded a particular stock. So that's generally how a mutual fund works. So I just kind of talked about the active funds, and then that someone is actively managed. Someone's managing that. So there's going to be load funds and no load funds. So that depends on what level the fees are. So when you're investing in a mutual fund, you also want to know what fees that fund manager is going to get, because let's say you invest $1,000 and your return there is 10%. They might take 1% out of that, so now your return's 9%. And, that may not be unreasonable, especially if they're managing it well and they're, returning a good, providing a good return to the investors. 1% may not be bad. Some would be 0.5% or maybe even lower. So could still be a good investment. Then there's also passive funds. So tracking funds are some of them. So basically what it'll be is there's a Dow tracking fund, a number of them. There's S&P, Russell 500 index. And so what these ones will do is they will basically say, okay, here's what's in the Dow Jones Industrial Average. We're going to go out and buy stocks or bonds or whatever to match that return, or to match what's in the Dow Jones Industrial Average. So they might say, okay, here are the 30 stocks in the Dow. I'm going to go out and buy in ratio to the Dow Jones, and therefore my fund of what I own will return you the same thing owning all 30 stocks in the Dow Jones Industrial Average would be. So think about it. If you had to go out and individually buy each stock in the Dow Jones Industrial Average and basically do them within the same percentages or the same amounts to make up that average, you'd be talking about a significant investment for sure. You can do that with $1,000 and get that same result within the confines of a mutual fund, having diversified yourself within the Dow Jones Industrial Average. Similarly, a NASDAQ fund or other funds, they might not have as high a level of management fees for you. And the reason why that is because it's not as much of a decision making that has to be done. So you don't have to have individuals scouring and looking at the results of each of these particular investments to say, well, I should get into this one, out of that one, we'll add some other investment, and so on and so on. That's already decided for them because they're investing in the Dow Jones or they're investing in the NASDAQ or whatever. So your results are going to be akin to what you would get in those indexes. So there isn't a lot of decision making, there isn't a lot of analysis necessarily. It's just, if it's in the Dow, it's in this fund. If it's in the NASDAQ, it's in the NASDAQ fund, and so on and so on. So that's where you'll find the actively managed as well as the passive funds. So what else within mutual funds would we potentially talk about? Well, one of the things I want to tell people that I don't think everybody would necessarily think of is that if you're investing in a fund, you're thinking, okay, well, within the scope of a particular fund too, you may not want to put all your money into one particular fund. So you might say, okay, I have $4,000. I'll put 1,000 into this Dow fund. I'll put 1,000 into this NASDAQ fund. I'll put 1,000 into this S&P fund. I'll put 1,000 into an international fund. So I have exposure to the world market, not just the U.S. market. So in each of those particular funds, what the other thing you need to do is to say, okay, I feel like now I'm diversified because I'm in 4 different funds. Are you? Well, the reason why I asked that question is you could have 4 different funds, and people often go and say, okay, I'm going to have Fidelity XYZ fund, or I'll have Janus ABC fund. What you need to know then is not just the Janus fund or the Fidelity fund or whatever else it might be, Franklin Templeton fund, so on. You don't need to know just that you're invested in those funds, and the first fund has been averaging 6% per year. The second fund has been averaging 9% per year, and so on. The other thing you want to know is what are the holdings of that fund? Because let's say Fund A has 20% in Coca-Cola. Fund B has 18% in Coca-Cola. Fund C has 22% in Coca-Cola. Now, you have a lot of your investment in Coca-Cola, and that wasn't really even your plan to begin with. So make sure that even when within your funds, now this applies to just buying mutual funds on their own, and it also applies to funds within a 401k or an IRA. Make sure that if you pick 4 different funds, that the 4 different funds really aren't made up of all the same things. Because you could have a fund that has, again, I'll use my 4 that I've mentioned before. You could have Verizon, Amazon, Home Depot, and Coca-Cola in Fund 1, the same 4 in Fund 2, and let's say 3 out of the 4 in Fund 3. So you're thinking that you're diversified because you're in 3 different funds, but in fact, you've picked 3 different funds that are all invested in the exact same thing, which would be the same as holding one fund. So it may not make sense from that perspective. So make sure within those funds that you have that you're picking the ones that give you the most diversity. And maybe you have to say, well, instead of picking 1, 2, and 3, I might have to do 1, 2, and 4, because 3 is so much similar to what I'm doing in 1 and 2, it would defeat the purpose of what I'm getting into as far as going into that one. So, thoughts so far. I would love to hear what your comments are. Please comment below if you're not watching the live stream, and tell me what your thoughts are. What is your strategy? What would you like to hear me talk about in future videos? The purpose of this live stream every Monday is to be able to provide people with my thoughts, but also get interaction and conversation with you, and to share ideas basically. So far what you've heard, do you like what you've heard? Have you heard these type of things? What so far that I've shared in the last 13 minutes, are you saying, well, I like that, or that's interesting, or I didn't know? I'd love to hear in the comments below. So, please go ahead and comment and let me know what your thoughts are. I will read every comment, and I will answer as many as I possibly can. So with that, let's continue on and talk a little bit more about mutual funds and, strategies within them. So, let's say you have a couple funds that are very similar. Take the time to look at, the comparison between them. Does one versus the other have almost the same investments, but one has higher costs and the other has lower costs? Well, it might make more sense to get into the lower cost one. Similarly, if it's outside of the confines of an IRA or of a 401k, you might want to look at how often they turn over their assets. Why? Because if Fund A goes ahead and sells the Coca-Cola shares that they have, it's either going to be at a gain or a loss. And assuming it's at a gain, you're going to have a capital gain to report. So you might want to consider how often do they roll over their investments, and what impact does that have on me, when those capital gains come and go. So, take a look at that as well. And again, if you're not comfortable with a lot of the things I'm saying, it might be worthwhile to reach out to an investment advisor who can provide you with their thoughts and, share a little bit more about their analysis of what might make the most sense for you and for your investment strategy. Now, as I always say, and I'll caveat this here as well, all the advice you get is worth what you pay for it. So, I hope my advice to you or what I'm sharing here is helpful. But again, it's one person's opinion and thoughts. And again, I want to learn from you and hear your opinion and thoughts as well. So with that also, what is your advisor telling you, or what is your strategy? Are you saving for retirement? Are you being speculative and just thinking that this is a good way to invest? One of the things I'm doing right now is, as the market's going up and down, is looking at the Dow Industrial funds. Spiders is one of the good ones, and the market goes down by 300 points in a particular day. Like today, it did go down over 300 points. I decided to buy in a little bit, and if it goes up, I'll get out. And then you can ride that up and down, up and down, up and down. The key in my mind is the up and down is to only do that with investments that you believe that if it were to go down for a significant period of time, you still believe in that asset and you would still hold on to it. Because the mistake that people make is they'll buy into something and it goes down and then they get fearful and they sell. And then it goes up and they say, oh man, I made a mistake, let me get back in. And they buy higher again and then it goes down. And so on and so on. You don't want to be in that cycle. Now, if you find something that's not doing well and you say, hey, the fundamentals of this changed and now I don't believe in it, get out by all means. But if something just goes down and you still believe in the company, hold on to the stock. Ride the down, ride it back up. Timing the market generally isn't going to be your best friend. It's usually going to cost you money. It's usually not going to be a good option for you. So what are your thoughts? Do you invest in mutual funds? Are you going to consider investing in mutual funds in the future and have other questions you'd love me to answer? I'd be happy to hear your comments below. I would also love to do future live streams based on your comments. I'll also do other videos outside of live streams based on what your questions are and what you find to be the most valuable to you. Suggest other topics that I can talk about. Definitely give a thumbs up and like this page so that, in the future I can provide you with better content, more information, and really build that dialogue, build the conversation, and provide the best possible solution and information to you. So go ahead, if you haven't already, subscribe, like this video. It's definitely helped. Share it with other people. Tweet it, put it on your Facebook page, whatever it might be. And thank you for watching, and I greatly appreciate it. I do these every Monday night at 9 p.m. to roughly around 9:20, 9:30. And, like I say, thank you so much for watching, and we'll see you in the next one.